What if I told you that one half of Warren Buffett's brain, the half that taught him to stop buying mediocre companies at fair prices and start buying wonderful companies at fair prices, belonged to a man you probably never heard of before the era of Silicon Valley and venture capital, before growth investing was a term you'd see on financial news, before the internet gave us access to endless data, a time when finding a truly innovative company required more than a stock screener. It required the skills of a detective. It seems like a contradiction, doesn't it? In a world dominated by Benjamin Graham's philosophy of value investing, of buying statistically cheap, unloved cigar, but companies, how could a completely different approach, one focus on paying up for quality and growth, become the secret weapon of the world's greatest investor? The answer is simple, and it represents one of the most important evolutions in modern investment thought. Because while a cheap stock can give you a quick, one-time profit, a truly great, innovative, and well-managed company can compound your wealth for a lifetime. Finding these rare gems is the holy grail of investing, and the man who wrote the original map was Philip A. Fisher. Welcome to Capitura. Today, we are not just reviewing a book. We are learning a new way to see the world. We are taking an audiobook-style journey into the foundational text of growth investing, a book that has been a secret weapon for Wall Street insiders for over 60 years. Common Stocks and Uncommon Profits by Philip A. Fisher. This is not a summary of financial ratios or valuation formulas. This is a manual for becoming a business analyst, a qualitative detective who looks beyond the numbers to find a handful of companies that will shape our future. We will explore Fisher's legendary Scuttlebutt method of investigation and his detailed 15-point checklist for identifying companies with the potential for astonishing long-term growth. Stay with us, because the principles in this book are the bridge between old-school value investing and modern growth investing. They are the intellectual framework that will teach you how to identify the next generation of world-changing companies, and just as importantly, give you the conviction to hold on to them for the long run. Introduction: the other genius of investment philosophy. When people talk about the intellectual giants of investing, one name dominates the conversation: Benjamin Graham. He was the father of value investing, the man who taught Warren Buffett and countless others to demand a margin of safety and to buy stocks for less than their tangible assets. But there was another genius, a quiet and intensely private man from San Francisco named Philip Fisher, who was developing a completely different and arguably more powerful philosophy. Fisher began his investment firm, Fisher & Company, in 1931, in the depths of the Great Depression. While others were sifting through the wreckage for bargains, Fisher was looking for survivors, innovative companies that had the resilience and the vision to not just survive the downturn, but to thrive in the decades to come. His entire career was built on one profound idea: the greatest investment returns do not come from buying mediocre companies at a cheap price, but from buying truly outstanding companies at a fair price and holding them for a very, very long time. He put this idea into practice with legendary success. He bought one of his most famous investments, Motorola, in 1955 and held it until his death in 2004, a period of nearly 50 years. He wasn't interested in what the stock would do next month or next year. He was interested in what the business would be doing next decade. His book, Common Stocks and Uncommon Profits, published in 1958, was the first time he shared his private philosophy with the world. It quickly became an underground classic, passed between serious investors like a secret text. Its most famous reader was a young Warren Buffett, who was so impressed that he made a special trip to meet Fisher in person. Buffett would later say that his own investment style evolved to be 85% Graham and 15% Fisher. That 15% was transformative. It was Fisher who taught Buffett to look beyond the raw numbers of the balance sheet and to appreciate the qualitative factors that make a business truly great: the quality of its management, the strength of its research and development, and its long-term competitive advantages. So, why does this book, written in the age of black and white television, matter in our hyperspeed digital world? It matters because the core principles of business success are timeless. Fisher's philosophy is the ultimate antidote to the short-term noise that dominates modern markets. Think about the culture of Robinhood and commission-free trading, which encourages a frantic, high-turnover style of investing. Fisher's core message is the polar opposite: find a few great companies and do nothing. The real money is made in the sitting, not the trading. Consider the intense hype and narrative-driven speculation around a stock like Tesla. Fisher's Scuttlebutt method provides a framework for cutting through the noise. It forces you to stop listening to the storytellers on social media and start doing the real detective work, talking to customers, evaluating the competition, and understanding the company's real, sustainable advantages. What about the world of cryptocurrencies? Fisher's rigorous 15-point checklist for quality is a powerful filter. Applying his questions about long-term profitability, management integrity, and research effectiveness to most crypto projects would reveal that they are speculative ventures, not the kind of durable, long-term investments he sought. It helps you separate the truly innovative technologies from the get-rich-quick schemes. Even for investors in the FIRE movement, financial independence, retire early, who often rely on diversified ETFs, Fisher's work offers a compelling alternative path. While ETFs offer common market returns, Fisher's concentrated, research-intensive approach is a blueprint for how one might achieve the uncommon profits of the book's title. Common Stocks and Uncommon Profits is more than a book. It's a complete operating system for thinking like a business owner. It teaches you that when you buy a share of stock, you're not buying a ticker symbol that wiggles on a screen. You are buying a fractional ownership stake in a living, breathing enterprise. Your goal is to find the best enterprises in the world and to partner with them for the rest of your life. In the chapters that follow, we will break down this entire philosophy. We will learn how to become a financial detective using the Scuttlebutt method. We will go through each of Fisher's 15 points for identifying a superstock, and we will explore his radical and highly profitable advice on when to buy, and perhaps more importantly, when to sell. This is not just a book summary. This is a masterclass in long-term, growth-oriented investing. Let's begin. Chapter by chapter breakdown. We will explore Philip Fisher's masterpiece by breaking it down into its core components, his overarching philosophy, his investigative method, his detailed checklist, and his practical advice on buying and selling. Part 1. The philosophy, clues from the past. The timeless principle. Fisher begins not with a checklist, but with a philosophy. He wants to reframe how we think about the stock market itself. He looks back at the previous 50 years and draws a simple but powerful conclusion. The greatest fortunes were not made by trading in and out of the market. They were made by people who identified a small number of truly exceptional companies and held on through thick and thin. He argues that the average investor makes a fundamental mistake. They spend all their time and energy trying to predict the short-term swings of the economy and the stock market, a task Fisher believed was impossible. This market timing approach leads them to buy high in a state of optimism and sell low in a state of panic. The correct approach, he insists, is to ignore the short-term noise of the market entirely. Instead, your sole focus should be on finding companies that can grow their sales and profits at a rate significantly faster than the overall industry for many years to come. If you can find these rare, outstanding companies, the short-term fluctuations of the market become irrelevant. A great company will create so much value over a decade that the price you paid, as long as it wasn't utterly absurd, will seem like a bargain in retrospect. Fisher makes a crucial distinction between a company's price and its value. The price is the emotional, day-to-day quotation on the stock market. The value is the underlying, long-term earning power of the business. The amateur investor is obsessed with the price. The professional investor is obsessed with the value. He also introduces a concept of inflation as a key reason to own stocks. In the 1950s, many conservative investors still believed that bonds were the safest investment. Fisher argued that this was a dangerous illusion. A bond pays a fixed interest rate, and its principal is returned at the end. But over time, inflation silently erodes the purchasing power of that interest and principal. A safe 5% return on a bond is actually a losing proposition if inflation is running at 6%. Outstanding companies, on the other hand, are the best protection against inflation. A great business can raise its prices to offset rising costs, thereby growing its nominal profits. This leads to a higher stock price and often higher dividends. Allow your investment to not just keep pace with inflation, but to dramatically outrun it. This was a radical idea at the time, but it has since become a cornerstone of modern investment theory. The core message of this opening section is a call to shift your entire frame of reference. Stop thinking like a stock trader and start thinking like a business owner. Your goal is not to predict the market. It is to find a handful of the most innovative, well-managed, and competitively advantaged companies in the world and become a long-term partner in their success. Modern takeaway. Fisher's foundational philosophy is a powerful anchor in the storm of today's hyperactive markets. His warning against market timing is more relevant than ever. In an age where financial news and social media provide a 24/7 stream of reasons to be bullish or bearish, the temptation to jump in and out of the market is immense. Fisher's advice is timeless. Ignore the noise, the daily chatter about inflation reports, Federal Reserve meetings, and geopolitical events is a distraction from the only thing that truly matters for a long-term investor, the underlying performance of the businesses you own. His view of stocks as the best inflation hedge has been proven correct time and time again. In the post-2020 era of high inflation, investors who were holding cash or low-yielding bonds saw their wealth decline in real terms. In contrast, owners of great businesses, companies with strong pricing power like Apple or Microsoft, were able to pass on rising costs to consumers, protecting their profit margins and delivering strong returns. Fisher's philosophy also provides a stark contrast to the mindset prevalent in the cryptocurrency world. Much of the crypto market is driven by short-term narratives and attempt to time the next bull run. A Fisher-style investor would approach the space very differently. They would ignore the daily price swings and ask fundamental, business-like questions. Which of these projects has a real, sustainable use case? Which has a durable competitive advantage? Which has a management team with unquestionable integrity and a long-term vision? By applying this filter, they would immediately dismiss 99% of the market as pure speculation and focus their research on a handful of projects that might have the qualities of a truly outstanding long-term investment. Fisher teaches us that the first step to achieving uncommon profits is to adopt an uncommonly long-term and business-focused perspective. Part 2, the Scuttlebutt Method, the Art of Investigation, the Timeless Principle. This is Philip Fisher's most famous and original contribution to the art of investing. If you want to find truly great companies, he argues, you cannot limit your research to reading annual reports and company press releases. This information is widely available and already reflected in the stock price. To get a real edge, you have to do what he called scuttlebutt. The term scuttlebutt is an old naval slang word for the gossip and rumors that sailors would exchange around the ship's water cask. For Fisher, it meant a relentless, on-the-ground investigative process. It was the work of a detective, piecing together a mosaic of information from a wide variety of sources to build a complete three-dimensional picture of a company. The goal of Scuttlebutt is to find out what the company is really like beyond the polished corporate image. Fisher believed the best way to do this was to talk to people. He would build a network of contacts and systematically interview them. His process involved talking to 5 groups of people. Competitors. Fisher believed this was one of the most valuable sources. He would ask the company's competitors what they thought of them. If a competitor grudgingly admitted that the company you are investigating is the best in the industry, has the strongest sales force, or the most innovative products, that is an incredibly powerful signal. Customers. Why do they buy from this company instead of others? Is it the quality, the service, the price? How loyal are they? Would they switch to a competitor for a small discount? This line of questioning reveals the true strength of a company's relationship with its market. Suppliers. Talking to a company's suppliers can reveal a great deal. Does the company pay its bills on time? Is it constantly trying to squeeze its suppliers on price? Or does it treat them as long-term partners in innovation? This can be a sign of the company's financial health and its corporate culture. Former employees. This could be a goldmine of information, though it must be treated with caution. A disgruntled former employee might have an axe to grind, but they can also provide invaluable insights into the real-life working culture, the quality of management, and any internal problems that are hidden from the public. Industry experts and academics, university researchers, or trade association executives often have a broad, unbiased view of an entire industry. They can help you understand the long-term trends and identify the companies that are truly leading the pack in terms of technology and strategy. Fisher's Scuttlebutt method is hard work. It takes time, patience, and social skill. But he believed it was the only way to gain a true informational edge. By the time you finish the Scuttlebutt process, you should know more about the company's real strengths and weaknesses than any analyst on Wall Street. This deep knowledge is a source of conviction needed to buy a stock and, more importantly, to hold it through the inevitable market downturns. Modern takeaway. In the information age, Fisher's Scuttlebutt method is more accessible than ever before. While it might be difficult for an individual investor to call up the CEO of a competitor, we can now conduct digital scuttlebutt with an unprecedented level of depth and scale. Customers. To find out what customers think, you no longer need to conduct formal interviews. You can go to Reddit and find entire subreddits dedicated to a company's products. Are the users passionate evangelists or frustrated critics? You can look at product reviews on Amazon or app ratings in the App Store. For a company like Tesla, you can find thousands of YouTube channels and forums where owners discuss every detail of their experience. This is pure, unfiltered customer feedback. Former employees. Websites like Glassdoor and LinkedIn are the modern equivalent of talking to former employees. You can read anonymous reviews from hundreds of current and former staff about the CEO, the company culture, and the long-term outlook. If a company has glowing customer reviews but terrible employee reviews, that could be a major red flag about the sustainability of its success. Competitors and industry experts. Twitter, X, has become an incredible resource for digital scuttlebutt. Many top industry executives, engineers, and market analysts are active on the platform. By following these experts, you can get real-time insights into competitive dynamics and emerging industry trends. You can see what the smartest people in the field are talking about and which companies they respect. The modern investor can use these tools to build a scuttlebutt file on any company they are researching. The goal is the same as Fisher's: to move beyond the official corporate narrative and understand the business from all angles. Is the hype around a new technology justified by what the engineers are saying? Is the company's claim of excellent customer service backed up by online reviews? The Scuttlebutt method, in its modern digital form, is the ultimate tool for separating a great, durable business from a temporary, narrative-driven meme stock. It is the hard work that leads to uncommon profits. Part 3. The 15 points. The checklist for a great business. The timeless principle. This is the intellectual core of the book. After you've done your scuttlebutt, how do you synthesize all that information? Fisher provided a rigorous 15-point checklist to systematically evaluate a company. This is not a quantitative screen. It is a qualitative framework for thinking about what makes a business truly exceptional. A company doesn't need to get a perfect score on all 15 points, but it should be strong in most of them. We can group these 15 points into 3 main categories: the quality of the business, the quality of the management, and the quality of the investment. A. The quality of the business. Does the company have products or services with sufficient market potential to make possible a sizable increase in sales for at least several years? Fisher was not interested in companies that could grow for a year or two. He wanted businesses operating in huge, expanding markets. Does the management have a determination to continue to develop products or processes that will still further increase total sales potentials when the growth potentials of currently attractive product lines have largely been exploited? A great company is not a one-hit wonder. It must have a culture of continuous innovation. How effective are the company's research and development efforts in relation to its size? R&D spending is not enough. It must be effective and lead to profitable products. Does a company have an above-average sales organization? A great product is useless if you can't sell it. Fisher looked for companies with a world-class marketing and distribution network. Does the company have a worthwhile profit margin? A company must be able to translate its sales into strong profits. What is a company doing to maintain or improve profit margins? The best companies are relentlessly focused on efficiency and cost control, ensuring that margins remain strong even as they grow. Does the company have outstanding labor and personnel relations? Happy, respected employees are more productive and innovative. Fisher looked for companies with low employee turnover and a strong company culture. B. The quality of the management. Does the company have outstanding executive relations? The senior management team must be cohesive and work well together. There should be no internal politics or infighting. Does the company have depth to its management? A great company is not a one-man show. It must be actively developing the next generation of leaders. How good are the company's cost analysis and accounting controls? Management must have a precise, detailed understanding of where every dollar is coming from and where it's going. Are there other aspects of the business, somewhat peculiar to the industry involved, which will give the investor important clues as to how outstanding the company may be in relation to its competition? This is a catch-all for a company's unique secret sauce or competitive moat. Does a company have a short-range or long-range outlook in regard to profits? A great company is willing to sacrifice short-term profits by investing heavily in R&D or marketing. To build long-term dominance, i.e. in the foreseeable future, will the growth of the company require sufficient equity financing, so that the larger number of shares and outstanding will largely cancel the existing stockholders' benefit from this anticipated growth. Fisher wanted companies that could fund their growth through their own profits, without constantly diluting existing shareholders by issuing new stock. Does the management talk freely to investors about its affairs when things are going well, but clam up when troubles and disappointments occur? This is a crucial test of integrity. Great management is transparent and honest, in good times and bad. C. The quality of the investment. Does the company have a management of unquestionable integrity? For Fisher, this was a non-negotiable deal breaker. If you cannot trust the management, nothing else matters. This 15-point checklist is an incredibly demanding framework. Very few companies will pass all the tests, but that is precisely the point. Fisher was not looking for good companies. He was looking for the tiny handful of truly great companies that could compound wealth for generations. Modern takeaway. Fisher's 15 points are a timeless tool for separating durable, high-quality businesses from speculative fads. In today's market, this checklist is more valuable than ever. Let's apply it to a modern growth icon like Apple. Does it have long-term market potential and a commitment to new products? Points 1 and 2, absolutely. The iPhone ecosystem is still growing, and they are constantly pushing into new areas like services, wearables, and augmented reality. Is its R&D effective? And does it have a great sales organization? Points 3 and 4, yes. Its R&D is legendary, and its global brand and retail presence are unmatched. Does it have great margins, labor relations, and management depth? Points 5, 7, 9. Yes, its profit margins are world-class. It's consistently ranked as a top place to work, and it has a deep bench of executive talent, as management transparent and a high integrity. Points 14 and 15 generally yes. Apple's management is known for its professionalism and long-term focus. Now, let's apply the same checklist to a typical meme stock. For example, a struggling retail company that becomes a temporary speculative favorite. Does it have long-term growth potential? Point 1. No, its core market is often shrinking. Is its R&D effective? Point 3. It likely has very little R&D. Does it have worthwhile profit margins? Point 5. No, it is often losing money. Does it have management depth and integrity? Points 9 and 15. Often, the management team is in flux and the focus is on short-term survival, not long-term vision. The contrast is immediate and stark. Fisher's checklist instantly reveals the difference between a world-class business and a low-quality speculation. It forces you to think like a long-term business owner, not a short-term gambler. It is the ultimate framework for quality-focused investing. Part 4. When to buy and when to sell: the art of patience. The timeless principle. Having identified a great company, the next questions are practical. When should you buy it, and when, if ever, should you sell it? Fisher's advice here is both simple and profoundly difficult, as it requires going against our most basic human instincts. When to buy. Fisher was not a market timer, but he was very particular about his entry points. He believed that the ideal time to buy a great company is when it is temporarily out of favor with the market. He identified two primary scenarios for a good buying opportunity: during a period of broad market fear. This is when a bear market or a sharp correction is causing investors to sell everything indiscriminately. The prices of even the best companies are dragged down by the general panic. Fisher saw these periods not as a time to be afraid, but as a rare opportunity to buy shares in outstanding businesses at bargain prices. The key is that your decision is based on the quality of the company, not on a guess about where the market will bottom when the company itself faces a temporary problem. Sometimes, a great company will hit a rough patch. Perhaps a new factory has startup problems. or a new product line is a temporary disappointment. The market, with short-term focus, will often overreact to this bad news and punish the stock severely. A Fisher investor who has done their scuttlebutt and understands a company's long-term strengths can recognize that the problem is temporary and solvable. This allows them to buy from the panicking short-term investors at a deeply discounted price. When to sell. This is perhaps Fisher's most radical and important teaching. His answer to the question, when should you sell a great company, was essentially almost never. He believed that the single biggest mistake that investors make is selling their winners too early. They buy a great company, it doubles in price, and they get nervous and sell to lock in their profits. A few years later, they watch in agony as the stock goes on to rise another 1,000%. Fisher argued that if you have truly found one of the rare, outstanding companies, the gains over a decade or two can be so enormous that selling it for a small short-term profit is a historic blunder. He laid out only 3 valid reasons to ever sell a stock. You made a mistake in your initial analysis. After buying, you learned something new through your ongoing scuttlebutt that shows the company is not as great as you originally believed. In this case, you should sell immediately, regardless of price. The company has fundamentally deteriorated. The company no longer meets the 15-point checklist. Perhaps management has lost its way, or its competitive advantages have eroded. The business is no longer the great company you bought. You have found significantly better opportunity. This is a very high bar. It's not enough to find a company that is slightly more attractive. The new opportunity must be so overwhelmingly superior that it justifies selling a proven winner to fund the purchase. Notice what is not on this list. The stock seems overvalued. The market is about to crash. I want to lock in a profit. Fisher believed that trying to sell a great company because its valuation seems high is a fool's errand, because a truly great company will consistently grow into and exceed what seems like a high valuation today. Modern takeaway. Fisher's advice on buying and selling is the ultimate contrarian strategy in today's market. His advice to buy during periods of fear is timeless. The COVID-19 crash of March 2020 was a perfect Fisher buying opportunity. The market was in a state of absolute panic. An investor who had a watch list of great, high-quality companies and had the courage to buy during that panic made astronomical returns in the years that followed. This stands in stark contrast to the amateur investor who, driven by fear, sold everything at the bottom. His almost never-sell philosophy is a direct assault on the entire culture of modern trading. The Robinhood app, with its constant notifications and focus on short-term price movements, is designed to make you trade. Fisher's advice is to delete the app from your phone and look at your portfolio once a year. His philosophy is the intellectual foundation for the buy and hold strategy that is so often talked about but so rarely practiced. Think about the investors who bought Amazon in the early 2000s and sold it after it doubled or tripled. They felt like geniuses at the time, but they missed out on one of the greatest wealth creation stories in modern history. A true Fisher investor would have held on, knowing they had found one of the rare, great companies. This requires an almost superhuman level of patience and emotional control, but as Fisher proved, it is a true path to uncommon profits. It teaches us that in investing, your temperament is often more important than your intellect. Modern context expansion. What would Philip Fisher say today? If we could transport Philip Fisher from the 1950s to today's digitally driven, hyper-accelerated market, he would be a fascinating combination of thrilled and disgusted. He would see an environment filled with unprecedented opportunity for his style of investing, precisely because almost everyone else is playing a completely different game. The tools of the trade, the internet, AI, and social media. Fisher would be absolutely astonished by the internet. He, who had to build his Scuttlebutt network through painstaking phone calls and letters, would see the internet as the greatest investigative tool ever created. The golden age of Scuttlebutt. He would view the modern ability to read customer reviews on Reddit, check employee satisfaction on Glassdoor, follow industry experts on Twitter, and watch deep dive product analyses on YouTube as a fulfillment of his wildest dreams. He would argue that there has never been an easier time for an individual investor to do deep qualitative research and gain a real informational edge if they are willing to do the work. The noise machine. However, he would be appalled by the sheer volume of short-term noise. The 24/7 financial news cycle, the constant stream of analyst upgrades and downgrades, and emotional echo chambers of social media would strike him as a massive distraction from the long-term fundamentals of a business. He would say that the modern investor's greatest challenge is not finding information, but filtering out the useless information to find the true signal. He would be deeply skeptical of AI-based investing and quantitative models. His entire philosophy was built on qualitative judgments that are incredibly difficult for a computer to replicate. How does an AI measure the unquestionable integrity of a CEO? How does it gauge the passion and creativity of a research and development team? He would argue that the most important factors that drive long-term business success are human factors, and that any purely quantitative model is blind to these critical inputs. He would see quants as people who are exceptionally good at measuring the irrelevant. The modern strategies, index funds versus day trading. Fisher's focused, quality-centered philosophy provides a unique perspective on today's dominant investment strategies. He would likely view index funds as a respectable, but ultimately suboptimal, solution. He would call it a commitment to mediocrity, the problem of diversification. Fisher was a firm believer in a concentrated portfolio of your best ideas. He would argue that when you buy an S&P 500 ETF, you're not just buying the next Apple or Google. You're also forced by the dozens of mediocre or failing companies in the index. He would call this diversification. Diversifying away your potential for uncommon profits is a solution for the unwilling. He would concede that for the vast majority of people who are unwilling or unable to do the hard work of scuttlebutt and deep business analysis, an index fund is a far better alternative than trying to trade individual stocks. But he would maintain that it is a path to common, not uncommon, returns. He would view the modern culture of day trading with a mixture of confusion and contempt. The entire enterprise of buying and selling stocks based on tiny, fleeting price wiggles, with no regard for the underlying business, would be completely alien to his philosophy. He would see it as the most extreme form of short-term speculation, the polar opposite of investing. He would argue that day traders are not participating in the wealth creation process of capitalism. They are simply gambling on the emotional whims of the crowd, a game that is almost impossible to win over the long run. Timeless principles as a shield against modern risks. In a world obsessed with speed, hype, and short-term results, Fisher's philosophy is more than just a strategy. It's a necessary anchor. Scuttlebutt as an antidote to hype. The modern market is driven by narratives. A compelling story can send a stock with no revenue to a multi-billion-dollar valuation. Fisher's Scuttlebutt method is the ultimate hype killer. It forces you to get on the ground and find out if the story is backed up by reality. This process would protect an investor from nearly every meme stock or speculative bubble. Long-term focus as a defense against volatility. The market is more volatile than ever. News travels instantly, and algorithms can cause flash crashes. A short-term trader is at the mercy of this volatility. A Fisher-style investor with their 10 or 20-year time horizon can simply ignore it. A 30% drop in a great company is not a crisis. It's a buying opportunity. This long-term mindset is a psychological superpower. Concentration is a path to true ownership. In an age where it's easy to own hundreds of stocks through ETFs, we often feel like we own nothing. Fisher's philosophy of a concentrated portfolio forces a shift in mindset. When you only own 8 to 10 companies, you are forced to know them deeply. You become a true business owner, not a passive collector of tickers. This sense of ownership is the source of the conviction needed to hold on for the long run. Philip Fisher would conclude that the modern market has created a massive divergence. On one hand, the tools for speculation, distraction, and short-term gambling have never been more powerful. On the other hand, the tools for deep, fundamental, long-term business analysis have also never been more powerful. He would argue that because so few people are willing to do the hard, patient work of the latter, the opportunities for those who have never been greater. Closing reflection. 10 timeless lessons from common stocks and uncommon profits. As we conclude our deep dive into Philip Fisher's masterpiece, we are left with a clear and powerful philosophy that stands as a timeless beacon in the fog of modern markets. It is a philosophy of quality, patience, and profound business acumen. Let's distill his wisdom into 10 timeless lessons. Invest in businesses, not ticker symbols. When you buy a stock, you are buying a piece of a business. Your focus should be entirely on the long-term prospect of that business, not on the short-term wiggles of its stock price. Quality is the ultimate margin of safety. While Benjamin Graham sought a margin of safety in a low price, Fisher found it in a high-quality business. A truly great company, with its innovative products and strong management, has a resilience that will protect it and you through any economic storm. Become a financial detective. The Scuttlebutt method, the greatest investment insights, are not found in public financial statements. They are found by doing the hard, on-the-ground research, talking to customers, competitors, and employees to understand a company's true competitive advantages. Management integrity is non-negotiable. The single most important factor in a company's long-term success is the quality and integrity of its management team. If you cannot trust the people running the company, nothing else matters. A long-term time horizon is your greatest competitive edge. The professionals on Wall Street are trapped in a game of quarterly performance. As an individual investor, your ability to think in terms of years and decades is a massive structural advantage. Use it. The best time to sell is almost never. If you have done your homework correctly and found one of the world's truly outstanding companies, the biggest mistake you can make is selling it too early. The power of long-term compounding in a great business is a force of nature. Concentrate on your best ideas. Diversification is a protection against ignorance. If you are willing to do the work to truly understand a handful of businesses, a concentrated portfolio will produce far better results. Diversification leads to mediocre returns. Innovation and R&D are the engine of growth. Look for companies that are relentlessly focused on the future, investing heavily in research and development to create the product and services that will dominate the next decade. Buy when others are fearful. The best opportunities to buy great companies come when the market is in a state of panic. Use broad market fear as your signal to go shopping for quality. Patience is the rarest and most valuable virtue. Investing is a marathon, not a sprint. The rewards go to those who have the patience to do the deep research up front, and the even greater patience to hold on and let their great companies work their magic over a lifetime. So, how can you, the average investor, apply these powerful lessons right now? It starts with a fundamental shift in mindset. The next time you consider buying a stock, stop and ask yourself, would I be comfortable owning this single business and nothing else for the next 10 years? This question forces you to raise your standards and think like a long-term owner. Start practicing digital scuttlebutt. Before you invest, spend a few hours being a detective. Go to Reddit and see what real customers are saying about the product. Go to Glassdoor and see what employees think of the CEO. Go to Twitter and see what industry experts think of the company's strategy. This simple act of investigation will give you a much deeper and more nuanced understanding than just reading a news headline. And finally, practice patience. The next time a market has a sharp correction and your gut is screaming at you to sell, take a deep breath and think of Philip Fisher. Ask yourself, has the long-term potential of the businesses I own fundamentally changed, or is this just short-term market noise? This simple question can be the difference between preserving your capital and making a costly emotional mistake. Fisher's path is not for everyone. It is a path of intense work, deep thinking, and uncommon patience. But for those willing to walk it, it offers the promise of its title, the chance to turn common stocks into a lifetime of uncommon profits. And there you have it, the profound business-focused wisdom of Philip A. Fisher's Common Stocks and Uncommon Profits. It is more than a book about stocks. It's a manual for identifying and partnering with the most innovative and durable companies of our time. It is a timeless guide to thinking like an owner, not a speculator. We hope this deep dive summary has given you a powerful new framework for your own investment journey and inspired you to look for quality and growth in the businesses you choose to own. The principles we've looked at today are the bedrock of true, long-term wealth creation. If you found value in this breakdown of common stocks and uncommon profits, make sure to subscribe to Capitura and click that notification bell. We're on a mission to bring you the world's most powerful financial wisdom, chapter by chapter. And you won't want to miss what's next, because we're covering another classic that can completely change how you think about money and markets. Thank you for investing your time with us. Now go and be an intelligent investor.